Hello, everybody. John King with Summit Funding. It is Friday, the 28th of March, and here we are with another update from Mortgage Land, and it is getting crazy. So a lot of information to cover this week. I want to dive right in because there's a lot of misinformation, a lot of accurate information, and a lot that you need to know. So what are we talking about today? First of all, we are talking about homeownership just got harder. The federal government has made some changes this week, some announcements in some somewhat unconventional ways that has significantly impacted certain programs. And I want to dive into what it is, what it means, who it impacts, and what's the result of this going to mean. So let's get started. First of all, FHA cuts off loans for non-permanent resident aliens. What does that mean? Well, I'm going to go through and kind of show you what it means, but basically there are three categories of citizenship. You've got U.S. citizens, you've got permanent resident aliens, and you have non-permanent resident aliens. So obviously U.S. citizen is self-explanatory. Permanent resident alien is someone with what is referred to as a green card, which is a permanent resident ID card that gives them lawful admission into the United States and permanent status to stay here long term. So that is, they're not a U.S. citizen yet, but they have legal status that is a permanent nature. Then there's non-permanent resident alien status. And I'm going to explain to you kind of what that means and what that changed. But ultimately, what it means is effective on May 25th. If you are a non-permanent resident alien, you can no longer get FHA financing. Well, here's a bigger problem. People who took out FHA loans that want to refinance those into new FHA loans. Now, you can refinance into conventional loans, but if you want to refinance into an FHA loan and you had done one previously, there's a tool called a streamlined refinance that allows you to refinance without necessarily needing to look at your credit or your income, and you don't need to do an appraisal. It's a very simplified process to refinance if you don't qualify for normal guidelines of refinancing, but rates are low enough that you can save money off your monthly payment. But if you're a non-permanent resident alien and you have an FHA loan and it's after May 25th of 2025, you can't refinance that, which means you have to qualify for conventional, which has much, much stronger credit criteria. So it's also going to cause people who were looking forward to being able to refinance to not be able to do that refinance. Now let's dive in a little bit deeper on what this looks like. All right, let's go here. And so this is some excerpts of articles that I pulled together over the last 48 hours. So basically on this is as a result of President Trump signing an executive order back on February 19th that he called the taxpayer subsidization of open borders. And basically, they're saying, hey, we currently allow immigrants who are not permanent residents to get FHA loans, and we are cutting off their ability to do so. Now, this is interesting because previously we had no problem doing this with one exception, which was DACA recipients. DACA is Deferred Action for Childhood Arrivals. DACA was put in place, it was created as a category for people who were brought in typically, and I can be from any country as far as I know, but most of the clients I've dealt with were people that came from Mexico. Their parents came to the United States without legal authorization, without legal status, and brought these children over while they were minors. And so the thinking by President Obama was that, hey, these kids, it wasn't their choosing to come to the United States illegally. So we're going to do what's called deferred action, give them the right to own a home or to have some form of status in the United States. You can argue if you like or dislike the concept. I'm not arguing that. I'm explaining what it is. Now, back in 2019, Trump said, we're not going to allow DACA recipients to get FHA loans. So that particular group of non-permanent resident aliens, Trump said, we're not going to allow that. Well, then on this final day in office, Trump says, okay, fine. We will allow DACA recipients to get FHA loans. And so that was allowed as one of Trump's last actions before he ended his first term. And then we fast forward to today. And basically, we've got the federal government saying, hey, we don't want to spend our resources on people that aren't citizens of the United States. Again, we can agree or disagree. I do not ever want to make my platform political. I'm just being factual. Now, HUD Secretary Scott Turner went a little further than I think is appropriate for anybody to go by saying, hey, HUD is prioritizing Americans, not illegal aliens, and that the president promised to end taxpayer subsidies for illegals. And today we put an end to illegals receiving FHA home loans. Well, guess what? If you are a non-permanent resident alien, you have a legal status here in the United States. How you got here, maybe you came illegally, maybe you came legally, but there's a lot of people, and I'm showing you right now what those categories are, of people who are non-permanent resident aliens that now are ineligible for FHA loans. So work visas, a lot of people in the tech industry, engineering, etc., they get H-1B visas. They no longer can buy a home using FHA. They can still use conventional, but they cannot use FHA. Other visas, again, different types of visas here. Religious workers, NAFTA visas from Canada and Mexico. Students and recent graduates. So there's a whole group of people that come from other countries to study in the United States. They get a student visa and then they stay. And those visas give them permission to stay for a period of time. I have a lot of clients who have done exactly that. And now those people are losing their ability to buy using FHA. DACA recipients, big one that we were just talking about, using their ability to buy using FHA. People who are seeking asylum. So we've got a lot of people, again, I'm not being political here. We've got a lot of people who have refugee status that have come from countries like Ukraine, who has been experiencing a war for the last few years. A lot of people coming over from Ukraine to be in the United States, and they have a work authorization. They have a social security number. They have a work authorization card. They have an asylum status or their pending refugee status. They used to be able to buy using FHA. They can no longer do so. So there's a lot of people who are losing their ability to do financing. So what's the story with this? What's this going to mean? Ultimately, conventional is still in play for a lot of these people, but conventional loans are harder to qualify for. So we're going to see a segment of the population that is going to immediately come out of the home buying pool. Now, what does that mean for other buyers? Well, it means there's less competition. What does that mean for sellers? It's going to mean that there's less potential buyers out there buying your home. How's that going to impact the broader market? It's hard to tell. Okay, what I can tell you right now is this is one of two changes this week. This one we have more time, more runway on. So if you or someone you know are in this category of being a non-permanent resident alien and you planned on using FHA, you have to get into contract and your lender has to assign the case number no later than May 25th. So if you delay, you're going to lose your ability to buy a home using FHA. Again, you can still do conventional loans, but be careful because I had an example I learned the hard way a month and a half ago that DACA is not allowed by Freddie Mac, but it's allowed by Fannie Mae. So there's some weird situations there that are going to create some unique situations. And if you have questions about that, you scan this QR code and set up time to talk to me. I'd be happy to help. All right, let's go to the second thing. This one's going to have a bigger impact. This one is FHFA. That is the Federal Housing Finance Authority. And they issued a notice via Twitter, X, on Monday night, Tuesday, that eliminated something called a SPCP, Special Purchase Credit Program. And let me explain to you why that matters. So first of all, let me go back here and share with you again what we were looking at. So SPCPs are basically a waiver to anti-discrimination. I'm gonna say it that way. It basically, you might say it's somewhat like the affirmative action laws that have been repealed also recently, where people got preferential treatment in getting admission to colleges because there was a underrepresented percentage of a particular population that was getting admission to college or was getting mortgages. And so they were creating programs to say, well, how do we take this underrepresented group and get more of that for them? And this actually was created back in 1976. So we're talking about 49 years ago that this program was created, but it wasn't used very much, because lenders were afraid that they were going to get in trouble because, well, how can I use a program that gives preferential treatment to one group, even if they are a minority, whether it be low income, whether it be particular class of demographics, lenders were super scared to use it. And so it wasn't until 2021 when HUD said, hey, you're cool. Like, we're not going to come against you. And in 2022, Fannie and Freddie started really expanding these programs. And a lot of them had to do with geography, had to do with specific locations where home ownership rates were low. It had to do with specific demographics regarding the two categories that mostly were African American and Hispanics that were being assisted with this. But there's a lot more people and a lot more programs that even I didn't realize were out there. And so what ended up happening is March 25th, 3 days ago, the head of I don't know who it was. The head of the FHFA, William Pulte, announces via Twitter, X, that we are eliminating all special purchase credit programs effective immediately. What does that mean? It means a lot of grant programs, especially programs that were provided specifically by mortgage companies, are going to go away. And as a matter of fact, they're going away immediately. So what is this ultimately going to mean long term? It's going to, again, just like the lack of buyers that we're going to see coming, the buyers coming out of the buying pool because of FHA's decision about non-permanent resident aliens, this is going to impact a bigger group of people who are currently looking for down payment assistance programs. Now, I don't expect it's going to impact any of the down payment assistance programs that I am typically talking about. My company does have some special purchase credit programs that are going away. None of them have been ones that I've really been promoting. So Cal Half a Dream for All, Cal Half at All is not going to get impacted. I've got down payment assistance programs that are nationwide in other states. If it's run by the state, it isn't likely to be impacted. What we're talking about is programs that are run by particular mortgage companies. So here's what they were really looking at. A special purchase credit program targeted things like minority residents of low-income census tracts, residents of majority Black census tracts, operators of small farms in rural counties. They created programs for them. Minority or women-owned small business owners, there were programs created for them to become homeowners and get special incentives. Consumers with limited English proficiency, or residents living on tribal lands. Some examples of these is that they eliminated a down payment requirement and eliminated closing costs for first-time homebuyers in certain markets that had a large population of Blacks or Hispanics. Those programs have proliferated, have grown significantly in the last 3 years, and they're gone effective right now. Now, there's a timeline on some of them on how quickly they're going to go away, but they're all going away. And so another one, allowing low down payment and eliminating mortgage insurance requirement and increasing lender paid assistance in majority Black and Hispanic census tracts in Los Angeles. There's a specific example. That same lender had a program to make it easier for small businesses owned by women, minorities, and veterans to qualify for loans by lowering its threshold for credit scores and other underwriting variables and relying more heavily on cash flow analysis and alternative credit data. Other ones, identifying existing minority mortgage home buyers with the bank who would benefit from refinancing at a lower interest rate. Other ones provided a $5,000 lender credit and flexible underwriting standards for loans in Black and Hispanic communities that the banks serve. I'm going to go through some examples really quick here, and then I'm going to give you a big picture of what I'm talking about. Bank of America has a program called the Community Affordable Loan Solution. First-time home buyers, zero down payment, zero closing cost mortgage. It's gone. Guarantee Rate offered a program that gave $8,000 in assistance to help borrowers overcome accessibility challenges and move in repair costs, et cetera. Wells Fargo had a program that was designed to help minority homeowners who have a mortgage with the bank to refinance at a lower interest rate. All of those programs were special purchase credit programs, and they're all going away. Let me explain this in a simple way. I had a client that came to me about a month and a half ago. And it was a past client who brought him into my office, and we sat down. And the first thing he said is, "Hey, John, if I can be blunt." And I said, "Yeah, I'm blunt. I like people who are blunt." And he goes, I've got an offer from another bank, and I want to sit down with you to see. It sounds too good to be true. And my friend said, I need to talk to you. And I said, "Okay, tell me about it." And he goes, "Basically, it's a 3% down home loan with no mortgage insurance at a 5.9% interest rate." And I said, "Who's it through?" And he goes, "It's through a local bank." And I said, "You need to take advantage of that right away." And he goes, "What do you mean?" And I said, "I can't touch it. And I didn't put it all together. I'm super smart. I know y'all are probably disappointed that I'm about to tell you the truth. I didn't understand the relationship between those programs and them being backed by special purchase credit programs. What I knew for my entire career, especially when I worked for Wells Fargo 20 years ago, is that banks would create programs through what's called the Community Reinvestment Act, which requires them to reinvest some of their money into the markets that they are banking in, that they have deposits from. Well, part of the Community Reinvestment Act was combined with these special purchase credit programs, and they were creating programs that would happen for a limited period of time in a limited geographic area for a limited pool of people. And all of these special purchase credit programs had to have those types of deadlines, those types of guardrails around the programs. And so these programs were out there that I would tell clients, look, if you found something, it's not a universally available program. It's something specific from that bank. And if they're offering it right now and you meet their criteria, run, don't walk. Get in there right away. Take care of it before the program goes away, because these programs, they were rarely available, but when they were, nobody could touch them, including me. And so I was telling people, go for it. Like, if you found it, do it. It's a community bank and they're doing these, they're real. And national banks were doing them as well, but they're very sporadic, very periodic. Guess what? They're going away. So that is a challenge for people who were counting on those programs. If you were in one of those criteria, you met those criteria, and you were getting qualified or working on those programs, your source of funding is about to go away. So that's a major issue. If you are a home buyer, if you're looking for grant programs, there's very few grant programs around. Most of the grant programs had to do with these special purchase credit programs. So just be aware, these changes are going to upset the apple cart. We're going to see a lot of impact on the lower end of the market. And I'm saying this just statistically, the people who are taking advantage of these programs were lower income, buying in areas that already had typically lower incomes, inner city areas, et cetera. And now we're going to see less programs, less tools to help those people purchase. So it is going to impact the market on the low end. That might create some opportunity for some other people that weren't using those programs that aren't going to have as much competition in those markets. The reality is, the underserved communities are right now being left behind. And I don't say that to be confrontational. I say that because you can agree or disagree, but first of all, home ownership, I think we all would agree, is important for building long-term wealth. And the catch-22 is you can't get there because you have to be well qualified in order to become a homeowner. For a lot of people, there's just too many hurdles to get there. And this opened up doors for those people that those doors are shutting right now. Will they open up again in the future? Who knows? A lot of this stuff is unfortunately political. I hate to say it, but is this about affordability? Is it about politics? I don't know. What I do know is I'm here to report the news. I'm here to tell you the truth of what is happening. And I don't think we're done with these changes. I think that the trade wars, the tariffs, the protectionist nature of where the administration is going is making its way through to mainstream America. And it's impacting us. Inflation, I think, is going to stay to be an issue. I think we're headed more and more towards a recession. I think long term, you could argue this is going to be good news. You can argue it's going to be bad news. Short term, it's painful. Our president said literally 6 weeks ago in his speech to Congress that there is going to be pain in the short term. Well, guess what? We are feeling more and more of this pain. And the problem is it's creating and sending mixed signals, because the president has said, and his administration, his cabinet officials said, hey, we are about home ownership. We want interest rates to go lower. We want affordability to be better. And yet some of the actions that they're taking are having the opposite impact. So what is their goal? What are they trying to do? Again, I'm cautious. I'm not trying to be political about this. I'm just trying to be clear that, I see your comment. In reality, I'll get to that in a couple minutes. But I want to be clear, there's a lot of mixed emotions that are happening right now. What does that mean ultimately? That there's a lot of uncertainty, not just in consumers. Consumer sentiment is at a recent low, which means consumers are concerned about the direction of the economy, the direction of the markets overall. We've seen the stock market be highly, highly volatile. We're seeing the interest rate market be highly, highly volatile. And it is not getting any more stable. All of these changes are creating even more volatility, and that creates a challenge as you're out there looking to buy a home. As you're out there thinking about, hey, do I want to sell my home and move up to a bigger home? When you're thinking, hey, do I want to start a new business? Do I want to grow my business? Do I want to buy investment properties? A lot of that is causing people to stop and pause and say, I don't know if I want to because I'm not sure where the economy is going. And the only advice I give you is, yes, think about the economy as a whole, but think about the economy of you. Where is your future? What are the next steps in front of you? You may be walking down a path where everything else around you is falling apart, but if the path in front of you is clear and stable and strong, then don't just walk down that path, run. Because the fear and uncertainty with everybody else around you can create everybody else shutting down. And if you can see a clear path that you can grow, that you can take advantage, not negative advantage, but take advantage of that opportunity and be able to further accelerate your goals of home ownership, your goals of building a real estate portfolio. When everyone else is scared, be aggressive. When everyone else is aggressive, be scared. That's a takeoff of a Berkshire Hathaway. What the heck is his name? Anyway, Warren Buffett. Warren Buffett saying. Anyway, all right. So I want to finish up on a couple of things. First of all, we are seeing I saw an article in the Wall Street Journal the other day talking about significant difference in markets between the Northeast and the Southeast. So you're talking about, New York, Pennsylvania, that whole area, highly active. Connecticut, the markets are highly active. It is a seller's market. Put a house on the market the next day, it's being sold right away. And then you go down to Florida and houses are sitting on the market. Great houses are sitting on the market for a long period of time. This is a scary time. And it's something to think about. If you're thinking about buying in Florida and you say, oh man, I'm not going to buy now because prices are down. Well, wait a second. It's a huge opportunity to buy. Long-term, house prices go up over time. And everybody says, but I wish I would have bought whenever. We're in one of those times of whenever right now. If you're thinking about buying investment properties, buying in those markets might be a great opportunity right now, even if the market went down a little bit further. I'm going to use an example that hopefully doesn't get anybody really too upset, but Tesla stock. So Tesla stock was up at $420 a share. It had dropped down to $230 a share, and now it's back up to $280. Well, people who are wanting to invest in Tesla, they're like, man, I wish I would have bought it at $230. But if you would have bought, even as it was going on its way down, it'll come back up. If you bought at $250, you were upset when it fell to $230. But now you're happy because it's back up to $280. So you can't let emotions drive long-term financial decisions. That's my point here. Don't let emotions drive long-term financial decisions. There are opportunities in certain markets that if you were already considering it and it fits into your plans, this might be the time to make it happen. Just know what the conditions are that are causing it. So part of what's happening in Florida is issues with insurance. Insurance costs are going up significantly. But Florida is also talking about getting rid of property taxes to make up for the high cost of insurance. So maybe it's a good time to buy because you're going to get in there before they eliminate property taxes. Now, who knows if they're really going to? But if they do, then everybody's going to start buying again and you'll be the smart one that bought. And long-term, people still need a place to live. But more importantly, there aren't enough homes. There are not enough homes. Home ownership, whether you own or rent, I'm not talking about. I'm talking about the number of homes that have been built versus the number of people that need homes. And again, I'm not talking just ownership. I'm talking renting as well. It's household formation is a term. When someone grows up, becomes an adult, moves out of their parents' house and occupies a unit, rental or ownership, themselves. So a household is formed. Now, when you sell a house and move to another one, you didn't form a household. But when one person moves out of the house to move into something and the remaining people stay behind, you've created a household. Household formation is continuing to grow, but the number of units out there has not. It's been stagnant for the last 2 decades, and we've had some growth in units, but nowhere near the growth that we've seen in households that were formed. So there aren't enough homes out there, and so now is the time to take advantage of an opportunity. If you live in Connecticut and you were thinking about buying a second home in Florida, this might be the best time to do it. As a matter of fact, your values are going up significantly in Connecticut. It's a great time to pull cash out and invest in on a property in Florida, as long as you're willing to wait it out the long term. This isn't a quick buy and flip situation. This is this fits into my long-term plans. So strategy-wise, and I'm going to end with this and then take questions. We've already got one question waiting. If you're watching live and you have questions, post them now. If you're watching recorded, post questions. I'll come back later and fill it in. But basically, look, strategies for you to navigate this tougher landscape is reevaluate your personal economic situation. If you are worried about your industry and your job being directly impacted by this, then take a step back and take a deep breath and say, maybe, just maybe, this isn't the right time to pull the trigger. But also think about it and say, well, wait a second, what are my alternatives? If my industry is impacted, do I have a skill set that is transferable to another industry? Is my spouse working, and do we have enough in savings that we could survive a period of time? And does homeownership still stick with my long-term financial goals? Because homeownership is a long-term play. It's not a short-term play. And so these are the things that you need to be putting through your head right now. But now is the time that people will look back and say, man, I wish I took advantage of that time when the market was softer. There's a lot of uncertainty right now. The market is softening in some regions. It's super strong in others. And so you have maybe, just maybe, you should relocate. Maybe you should be thinking about, hey, maybe I shouldn't buy in the state that I'm in right now. My job is remote and it's permanent remote. My company has the ability to transfer me to another location. I have a skill set that's transferable that I can find a job in that new location. Think about what's best for your family situation, your economy, your goals in your life, and then make your decisions from there. But don't get stuck with the noise of everybody else, because that's what happens all too often. We get stuck with the noise of what everybody else wants or wants for us or for themselves that we think we should want for ourselves, and we lose sight of the reality of what we should be doing. So I'm going to get off my high horse. I'm going to jump into questions. I think I only have the one question right now. And it's about Dream for All. So in reality says, didn't move on March 26th. Looks like no more vouchers are being issued. So I will tell you there was a bit of a delay in the voucher reissuance each of the last quarters when we hit kind of that deadline. So I was talking to a couple people already this morning, and I said, look, I get it. I agree. I'm feeling a little bit concerned myself. Unfortunately, this is kind of coinciding with what I've been talking about, that I think is likely that CalHEPA is not going to be issuing that many more vouchers. I did have somebody that got a new voucher on Monday. He's in San Diego County. So San Diego County issued a new voucher, at least one this week. So the question is, are they going to issue more, and is it going to come out next week? I think if we don't see anything by next Friday, our chances of getting a massive number of vouchers out again is pretty slim. I think they're going to be doing it in trickle effect. I hope that we're still going to get another bump, another release. And my expectations are that it's going to happen early next week. If it doesn't, then I think our chances of getting a significant increase in the number of vouchers is really, really low. The final thing I want to say, to repeat, is I have zero expectation. There is no money coming out this spring. There's none, like not just zero expectation. There's no money coming this spring. We will know in June or July whether they are releasing money for next year, but I don't really think we're going to see that. We're seeing a softening economy right now. This money for Dream for All, kind of like what we're seeing with what I talked about for the last half hour with the federal government shutting down programs. Now that's for different reasons, but it kind of is the same reason. And the same reason I'm talking about is saving money. So Doge, you can agree or disagree with Doge. Again, I'm not being political here. I'm being factual. President Trump, Elon Musk, Doge is trying to eliminate government spending so that we can bring the budget back in line. Well, in the state of California, our budget has not been in line for a few years. We are spending more than we are bringing in. And so when you look at the California Dream for All program, the money was actually allocated 3 or 4 years ago when we had a budget surplus. We then very quickly had a budget shortage. We shifted very, very quickly. Our income went down, our expenses went up, and we don't have extra money. I don't see us having that. Kitty says hi, by the way. I don't see us having that extra money this summer. I don't believe that the state government is going to be able to allocate money towards a program. This was specific money earmarked out of the general fund for the Dream for All program. And if they don't have money to pay for basic services, if they're dealing with issues right now with disaster recovery because of the horrible wildfires in Southern California, I don't expect that the state government is going to have extra money, and they're not getting any from the federal government. That is super clear. If you haven't picked up the message, the federal government is cutting back on programs. They're not enhancing them. This money never came from the federal government. If you hope they'll come to the rescue and provide money to the state to continue this program, there's no chance of that happening. And I think it's a really, really slim chance that the state is going to have money this summer to allocate to the next budget year. I think our next realistic chance is going to be in 2025 for money that releases in 2026. This is 2025. In 2026 for money releasing in 2027. But I think we're headed more likely towards a recession. And a recession is bad news for the state coffers, for the federal coffers. They are going to have even less revenue coming in because a recession means that the economy is producing fewer goods and services. And therefore, if that recession does come, then there's less money coming in to the state government, which means they have less chance of having extra money to put towards Stream for All. I know that's not what you guys want to hear. We're also talking today about other programs that have been cut. There's amazing programs that are still out there. I think we're in a great time to be buying a home because we still have a housing shortage, and the opportunities I think are going to come from people who own homes now that in the future will start building an ADU in the backyard. California is paving the way for you to be able, and other states as well, for you to be able to build an ADU in your backyard and then sell that as a separate unit. You basically turn your entire lot into a condominium as far as how zoning and legal works. And the land becomes one thing, and then your original house and the ADU is a different thing, and you can sell the ADU. You could retire, move into the ADU, and sell the main house. There's a lot of cool things that are coming, and homeownership is the number one way to build wealth. As a reminder, because I haven't said it in a while, study was done last year. The average homeowner's wealth for everything. So their total net worth for the average homeowner was $393,000. The average net worth for a renter, $8,000. Huge difference. Now, there's a lot of other things that come from with net worth, but 82% of the average net worth is in their home. And so if you're a homeowner, you have the higher likelihood of building long-term wealth to support yourself, to support your family, to support future generations. I am a huge fan of homeownership, tax deductions and tax benefits, equity and appreciation, and paying down your mortgage every single month. And just the fact that you got the stability of knowing this is mine. I'm going to be here long term. I get to raise my kids here. I get to have my grandkids come over and visit me here. I got a pool in the backyard that we all get to have summertime parties in. That feeling of being a part of a community is critical. And I want that for as many people as possible. So I am interviewing for the job to be your lender. If you have questions about anything at all, please give me a call, whether you're looking to purchase a home or refinance or strategize, want to buy investment properties and grow your portfolio. I'm your guy. I really appreciate everybody listening today. If you have any other questions, reach out. Have a wonderful weekend, and we'll talk to y'all soon. Bye-bye.